Hi, Jason.
How are you?
Great. Thanks, everybody, for joining us. This is Justin White, Managing Partner of Centennial Advisors. I'm excited to be joined by Jason Brooks today at Buckhalter, who is my regular guest when we talk about issues impacting real estate investors in California. And we've got an hour filled with you today on what would be our second to last webinar of the year. For those of you that regularly attend our webinars, on the 22nd, we will be having a special one entitled The Opportunity Zone Secret. If you want to figure out maybe some of the untapped opportunities in opportunity zones, Jason and I will be going through that for an hour. But today we're going to talk about a lot of things that we've been talking about all year and what we think are going to happen in 2022. The first place I'm going to start is a couple nights ago, my wife and I went to an event. We talked to a good friend and multifamily investor, Gary DeLong, here in Long Beach for a little bit. And one of the comments in the back and forth conversation was that my wife said, you know, a year and a half ago when our kids came home from school, we thought that, or they told me that they were only going to be home for 3 weeks. Well, like a year and a half later, they finally went back to school. And it seems like we're kind of in that spot with evictions right now. So we'll start there, Jason. While when they first came out and we had the first run of time that there were going to be eviction moratoriums and rent freezes and all those things, we thought we'd get past them. Kind of give us an update on where we're at with the ability to get people out in places maybe that we can't get them out still, or how it's going in places that we can, and what's your outlook on that for the rest of 21 and into 22?
So thanks again for having me. It's a great way to finish out the year. The eviction moratorium is now even more on a city by city basis because one of the things that the state legislature passed was that city moratoriums can stay in place even as a state moratorium expires. So for example, LA City, it's going to October of 22. An interesting one, Justin, that I found out about the other day doing a transaction for a client is Pasadena. Even if your tenants are paying, if they don't want to leave right now in certain property types in Pasadena, you can't evict them. You have to let them just roll on to month. We actually had an attorney at the firm who has a house there that he's renting out, and he wanted to evict just so he could move back in, and was informed by the city he's not allowed to. So that's become really interesting. But right now it's looking like most things are going to go towards the March-ish of 22 timeframe. January 31 is when you can really start looking at how you're going to evict people. You can sue right now for breach of contract for money owed, but evicting for non-payment, especially if people are in the program where you're getting state funds, is not allowed. And the interesting thing too is for those of you in LA, LA decided that they were going to administer the program on their own and then decided it was too much work. And then they kicked it all the way back up to the state. So there's been a lot of delays in getting payments out of for LA property owners, but not as much in Orange County.
We'll get back to payments in a second. Let's go back to evictions. I got 2 quick points I want to hit on.
Sure.
One, what you just said in Pasadena, I believe the first place that happened was either in Berkeley or Oakland, was the inability to evict somebody, even if you want to move back in. So we're seeing even that legislation, which at the time when it first came out, I think everybody thought was unexpected and maybe shocking. But not only does it not get tweaked or overturned in those areas, but we're seeing it expand throughout California. And did you say October of 22 for LA?
For LA City. Right now they're saying October of 22. So, and the interesting thing, by the way, is in like Pasadena and certain places, the tenant can be paying rent. It's not that, a lot of these protections are people that are filed COVID hardship paperwork, right? Like right now you can go evict people that aren't protected via COVID hardship in most places. We just had a client buy a building in Fullerton, 16 units. Everybody was paying. We served them all with the no fault just cause 16-day notice under AB 1482. No issue. Everybody's going to get out January 31st. But in a property where someone is protected, it creates a different issue. So, but Pasadena is everybody. It's not just those protected by the moratorium in general.
So everyone's protected once they get it, as long as they keep paying.
Right. And that's the issue right now is, people that aren't paying but getting state money are protected. And then in some places, people are still protected from no fault just cause evictions or non-renewals. But that's a very few and far between situation.
In the past, we've talked about using house rules to effectively get people out. If you have problem tenants, if you have somebody who's bringing the wrong, let's call it, element to the property, or a variety of reasons, house rule is going to help you get them out now, or you just stuck with them in places like Pasadena?
Pasadena is going to be
interesting.
No, Pasadena is going to be interesting because that's like especially if it's a health and safety issue. We evicted some people in the hard eviction moratorium when you couldn't evict anybody because they were creating an unsafe environment. Police were getting called to the property. So there are situations, if you're breaking the lease in a non-financial way, where you can be evicted right now. And remember, the other thing too is if you owe money or you're owed money, we can actually sue them for breach of contract in small claims court. And again, we've talked about this strategy before, which is more of like a tenant buyout. But when we file these small claims cases and serve the people and then send them a letter and explaining like, look, we can dismiss this and make this go away. If you want to move out, maybe we'll give you a 1 month's rent, but we're not going to pursue you for the money. But if not, a judgment against someone will affect their credit for 7 to 10 years. And that becomes a very scary prospect for people.
All right, before we get into the relief money and the process and your experience with it, I was going to save it for later, but I think it's appropriately timed now. In 2022, what's kind of your recommended different strategies, from easiest or most likely or most effective, whatever you want to call it, to get people out?
The first is going to be voluntary. So, let's say we're going to have two categories when we discuss this. The first category is people that are paying. If someone's paying and they're not protected in a city where you can't just evict, even if they're paying, you can just give them a notice that you're not going to renew. If you're 15 years or older, that's going to be AB 1482. You owe them 1 month's rent. You let them move out. That's the easiest of the ways to go about it. If they are also not protected, but they're going to be difficult, I would always recommend approaching a buyout versus, any fight. If they are protected, which is going to be the bigger issue for most of our clients on the call. The first issue would be if they do owe you money, you can sue for the breach of contract for the funds. That's option A. Option B is if they are breaking the lease by noise ordinance violations, safety violations, trying to evict them that way. And then the third is going to be, if you're going to have to wait it out and just hope that, nothing happens too bad to the building and that you're able to collect from the state before you try to evict them.
Awesome. Thanks for kind of wrapping up. Maybe we'll call it the first eviction portion of our webinar today, because it'll usually come back with questions that we'll spend a little more time on it. But now let's go into COVID relief. I know you've worked with a number of clients over the last 16 months to navigate through COVID relief programs. And then once all of the money came out and there was a process, talk about how it's going when somebody's involved in the state program, and then how that's different in some of the city administrated relief programs.
I would say that the state's the most efficient at it right now. LA, as I said earlier, quit and gave up on it and sent it back to the state. There are some cities that are paying fine. Most of the people are starting to see the money flow consistently. The biggest thing I have heard from all of my clients is you have to make sure everything gets submitted timely, make sure you get assigned a case number, and then consistently follow up with your case manager on your case number. And I'm talking call every Tuesday and Friday or every Monday and Thursday to push it along. There's a saying that the squeaky wheel gets the grease, and our clients that are constantly, whether they have their property management team doing it or they're doing it, the ones that are constantly calling, chasing the money are the ones that are getting paid. And interestingly, Justin, people are giving notices for their annual rent increases in places where there's no rent increase freeze, and then continuing to submit with the new rent increases on a go forward. And the state is honoring those rent increases as well.
So let's talk about that with maybe timing and dollars. How long is it taking typically? And how many months, or are there any caps? What's the most somebody's gotten either in dollars or months that you've worked with? And what happens when somebody gets money for a unit and then the tenant goes back on COVID relief after they've paid a couple months on their own?
So we've seen there's no issue if somebody comes off of COVID relief and then goes back on COVID relief. We're seeing people that are able to do that. I think those are situations where, people, generally speaking, you're telling the truth, because, they are submitting all their paperwork and they understand how it works. I think there is actually real fear about, falsifying your paperwork now, because there's a lot of these scams that came out during PPP and all those other where people are getting in trouble. I mean, we had the one client I told you that had a tenant arrested for lying on it in the courtroom. But I would say that money is the fastest that I've heard of is around 90 days from the application. But then we have people that are now continually keeping up their application every month to add more and more. And then so they might then receive a check. If you start building a good relationship with your claims manager that knows the file number, they might not pay you, this month, but if you sent in this month and last month, then next month you'll get both. It's really who you're working with and how active you are. I mean, Justin, one of the big things we've talked about over the last year and a half is how important active management is. Like, this is a perfect example of active management being a plus.
How long do you think this is going to last? That their owners are going to be able to get paid out?
That's a great question. If I had a crystal ball, I don't know. I think there's probably money into Q1. The economy is doing too well. I've said this 3 times, though. If you probably went back and watched videos for the last 6 months, the economy is doing too well for things to keep going, and it still keeps going. So I don't know, but I would say probably into Q1. And this is probably the first time where I've not said, oh, it's going to be over like in the next month or something like that.
One of those webinars many months ago, somebody said something about state of emergencies lasting for multiple years.
Yep.
It's funny. I think if we went back and found some of the clips and highlights from some of these things we've talked about over the last couple of years, there might be some really good nuggets in there. Let's talk a little bit more about legislation.
And Justin, on that state of emergency, that's how they extended LA City's, right? Like, LA City's emergency order goes till October of next year. So, and by the way, that's been really interesting, because also what's restricted that is RSO units can't raise rents. So there'll be like almost a 3-year period with no rental increases on rent controlled in city of LA.
Yeah, but in 2023, you'll be able to catch up for all of it, right?
Yeah, all of the 3% that they generally allow you, maybe. There's a big mayoral election next year that'll probably dictate what happens after that, from what I hear.
So let's talk some more legislation. Split roll looks like it's going to be back. It will be the Housing Affordability and Tax Act, or Tax Cut Act of 2022. Now, for those of you that have been on our webinars before, we talk a lot about the third time's a charm when it comes to major legislation in California. So split roll will be back. There's some tweaks and some changes. Why don't you give everybody kind of an update on what you're hearing on that, and any comments as it relates to it?
So you and I were just talking about this before we got on. Split roll is an interesting one. It's been scaring especially commercial property owners for a long time. At one point, it started scaring tenants too, but that might be a little different now, and that's something that we can talk about now. But look, I think that there's a lot of money that consistently gets spent to defeat this. I think it would not destroy, but hurt substantially the California real estate market if it happens. All of us have or know people or have properties where we bought it so long ago, 30 years ago, where the basis is very low. And if it got brought up to market, it would affect how much you're making and can you cover your debt service. It would affect, how much your tenants can afford and what their costs are, or what you try to pass through to them. So it's going to be difficult. I think there's going to be a lot of opposition and a lot of money spent to defeat it. I do hope that it does not pass. The people that it does hurt, like we've discussed, are the mom and pop investors, the people that have held stuff a long time. It doesn't really hurt the big funds all that much, because most of them buy and trade on a regular basis. And so they're not as affected by it. And they'll find other ways to pass it through if they can, through increases in rent and other things. But commercial properties will take probably a hit.
Well, the interesting part about this one, and I would say as I'm super hopeful it doesn't happen, especially to those long-term owners that have bought years ago and spent time and money investing in properties and contributing to their communities, are going to be the most impacted. And I would hate to see it happen. I'm a little bit more on the analytics side, and I do think this is the third time, and I think it's the It's been tested twice. It's been rewritten now to probably maximize success. It's certainly got a title that sounds really good for most people who, if they don't follow it, that it might be a different outcome. And I think that, we've talked about it a lot in these things, and you mentioned it a second ago, that the big REITs, the big institutional real estate players, it doesn't affect them because their turn period is 3, 5, 7 years in a lot of these properties. And so they're almost always acquiring or having properties where the taxes are almost marked to market. Where it's really going to affect people is the people that have owned it a long time. And what I would suggest, or the comments that I would make on it, are a couple things. One, we're 11, 12 months out before this is going to get voted on, and it's not on everybody's radar. And if you're a person that's owned a building a really long time, and you have a very low tax basis, and that's the reason you justify why it's a good investment, because your property taxes are low, can make one suggestion. You need to look at it and see really what your return on your equity is with the current low taxes. Then you need to ask somebody like us to look at it of what would it be if your taxes got marked to market in 4 years? And what can you do with that money to maybe get a newer property, one closer to home, or one that just makes you more cash flow in your golden years? I think there's a window in the first quarter that people really need to look at the opportunity and consider that it might happen, and what their options are before it becomes the widest known potential issue that slows market activity, pricing, whatever, as we get closer to November 2022. Any additional comments on that, Jason?
Yeah, and I think your analysis was spot on with the looking at your return on your equity. A lot of people make the mistake of looking at the return on the equity and what they paid for it, right? People are like, I put in 100,000, and what is my return off of the 100,000? But your actual equity in the property now might be $1 million. And are you making a sufficient return on the equity that's been built up versus the equity that you paid for it? And the only thing that's going to get hurt is the equity that you've built up when you get the reassessment, right? And that's where you're talking about, Justin. It drives your returns down. So I think now is a really good time. As we saw middle of this year, when there was the fear of the elimination of the 1031, it created this flurry of transactions. But if there's the fear of the elimination or the raises in property taxes, it'll create a flurry of transactions, but at a compressed pricing. It might be a better situation for a buyer that takes advantage of it, knowing that they like the property anyways and can just get a better price out of it. So I think now would be the time to analyze the sale and then, reposition.
Thanks for your comments there. We'll talk about one more legislative thing that I think we're going to see a lot of in 2022. And Jason, my question for you is, when there is a good-sized earthquake in Southern California and you turn on the news to hear somebody talking about it, do you know who you see every single time?
No.
If I told you her name was Lucy Jones and she was from Caltech, would you not know exactly who I was talking about?
I think now I would.
Okay. Because I think that there's very few things that we all know and we all see. And one of the things is Lucy Jones when there's an earthquake in Southern California. And why do I keep talking about Lucy Jones? Is because Lucy Jones is the biggest proponent for soft story retrofit of probably anybody in all of Southern California. And certainly she is well accomplished in her field and knows exactly what the impacts will be. And over the course of the last 28 years since the Northridge earthquake, we've seen LA and a lot of other cities in LA County, as well as Northern California, enact soft story retrofit requirements on apartment buildings. It started in LA in the early 2010s or 2010s, if we'll call it, and now is a requirement. There's quite a few buildings that are behind schedule, but I think that in 2022, as we start to move out of, let's call it this, the initial COVID phase, and let's hope that there's not any more, and we get back to a more normal goings on. In 2017, 2018, 2019, we were starting to see more and more cities enact soft story retrofit on their multifamily properties. And I think that that's going to come back and we're going to start to see it. And I bring it up because for those of you that don't know what a soft story building is, we can certainly educate you and show you what it is and tell you whether you have one. But two, those of you that do, looking at what happened in Los Angeles and what happened to Los Angeles property owners in the 2010s versus what happened in 2019 and 2020, about the cost associated with retrofit is probably a really smart thing to do in the next year or two as it becomes more common across Southern California that we see soft story retrofit. When LA started their soft story retrofit program or put that law into place that all the buildings that were soft story were going to need to be retrofitted, there have since been 12 cities in Southern California that have created their own legislation, and I think we'll continue to see more. So my encouragement to everybody is on this legislative side, one of the things you're going to want to get ahead of is soft story. And how much is it going to cost? Whether you want to go through the process, or is there a strategy and solution that if you have a building that is of soft story, can you effectively eliminate that problem without significant cost? And because we've got a lot of experience throughout California and a lot of these cities that have it, we've got some ideas and we can help some people that might own in Orange County or some of the other cities in LA that don't have it yet. But I think by the time we do this in 2023, we'll probably see another 15 to 20 cities that have some form of soft story retrofit. Jason, you got any comments on that soft story?
Yeah, a couple of things. One, costs are continually going up. So the sooner you do it, the better off you're probably going to be. It's costs a lot more now to do a soft story retrofit than it did 6 years ago. And contractors are busy, permits are longer to pull, and lenders are requiring it in a lot of situations now. So if you're going to go get a refinance, it's something you're going to have to think about. So I think, to Justin, to your point, the sooner that you think about it, the better off it's going to be. And it's just something that's going to be addressed. So it's something that is getting more costly. So jump on it early if it's something you need to do for your property.
Thanks a lot. Let's transition a little bit. We'll talk some transactions and some of the what's going on in the deals that we see. I guess the first question I have for you is kind of what's your outlook on interest rates in 2022?
So I think right now interest rates will continue to hold probably through the election next year. And then I think regardless of the results of the election, they're going to go up. I don't think we can continue to hold them much longer. We're already starting to see higher inflation, and that's still with the suppressed interest rates. I think that they're going to try to keep them down as long as they can. But if you do need to refi your property, now is still a good time. Rates are still low. Those of you that have apartment buildings, Fannie and Freddie usually get new allocations of funds at the beginning of the year. So it's a good time to look at that as well.
To Jason, supporting Jason's comments, what we've got for you on the screen is the Federal Reserve dot plot. For those of you that are on our webinars periodically, you know that we show this every so often. And what it is, it's the regional Fed director's prediction of where interest rates are going to be. And to Jason's point, for 2022, certainly in the early part of the year, I think we all have an opportunity to take advantage of great rates. Ones that we are probably not going to see is if you can, from the looks of this chart, the reserve chairmans certainly believe that and see rates going up significantly from where they're at today. So supporting Jason's point that's in the early part of 2022, taking advantage of interest rates, whether that's an acquisition, a refinance, or a trade, good timing or available to you right now to do something. Jason, you're involved with a lot of different investors. What product types are you seeing people trade out of today?
So we're seeing, it depends, right? So we're seeing a lot of big players come into big multifamily product, but that's only where they can get real scale. Besides that, a lot of our smaller investors, mom and pops, they're going from, a duplex, triplex, 4 units. We've talked a little bit about this, where managing's more difficult, or they're not seeing those returns, or they're looking for some more passive income, into triple nets. Triple nets have become really big, I think, and popular. I mean, this, a lot of REITs have been doing triple nets for a long time, and same with a lot of savvy investors, but triple nets have become a thing. We've also seen, smaller shopping centers, like retail strip centers, the ones that are on the corner, that are anchored by a good liquor store, a really nice nail salon, and maybe like a T-Mobile or a Sprint or something like that. Those seem to be really popular. And then right now, actually, we're doing a lot where people are chasing a little bit more yield, but on a safer side is, single tenant triple net in a complex, hospitality. So we're doing a deal right now where someone's selling a Katsuya in Miami, and they're buying, like an an anchor tenant steakhouse in another shopping center. They're buying some other kind of thing. So and those cap rates are pushing above, Justin, what you and I would normally see on like a Starbucks or Hardee's or anything like that. They're a little bit higher, but also, they're solid tenants in great locations. So those seem to be the things where people are seeing a little bit of extra juice. People always want to be getting right now into industrial, but like cap rates are really compressed and there's not a lot there. So those are the things I think we're seeing. And a few people going into hospitality for the first time, which is a little bit of a risk, but I think if you buy it at a depreciated enough position, you can make some money.
Talk a little bit about that. Let's call it one-off retail, or you're talking about the Katsuyas and the, into the steakhouse, because they do offer higher cap rates. I guess, first off, are your clients capital preservation, or are they building wealth that are acquiring those? And two, how are they evaluating the security of the income stream? And how does it, in your opinion, how does it compare to a more traditional net lease of a Starbucks or a Raising Cane's or a Dutch Brothers or something like that?
So I would say that the people that are buying those right now are in the middle of capital preservation and capital growth, right? Like they're looking for a little bit more juice. They're a little bit younger. They want a little bit more upside. They might also know something about the hospitality space. So there's more risk involved, I would say, than doing a Starbucks, Hardee's, Raising Cane's, Dutch Brothers with a good tenant. So the cap rates are a little higher. But they're underwriting and looking at, how long has the tenant been there? Same things we would look at with a normal triple net. How many locations does the franchise operator or the corporation have? What's their stability? How did they produce through COVID? A lot of these, by the way, are in states that have been allowing indoor dining for an extended period of time. I would say most of these deals are actually in Florida. So there's that benefit as well. We're not seeing them do these deals in, Southern California or Manhattan.
Okay. Great. Hey, what are some of the things that your large clients do to be successful that not enough smaller clients do?
So push rents the max that they can every year, no matter what. And if it causes you to turn a unit, understand that that's okay. You're going to turn the unit for maybe a month and you're going to get someone in there at a locked in higher rate. You got to constantly be pushing. There's a reason that, places like the Irvine Company run off of a formulation on what each unit's going to go for at what time. And sometimes they're better than others. Like you could go to rent a 2-bedroom this week and pay X, and next week it's X plus $50. And the following week it's X minus $40. So you got to push your rents as much as you can, actively manage. One of the things that we talk a lot about with clients is that are looking to make more money is there's two ways, right? You can increase revenue or lower costs. A lot of people don't think about the lowering cost side. So putting in a RUB system is really popular right now. If you don't have a RUB system, if you have the ability to put in washer dryer hookups, we're seeing clients get $100 or $150 more a month in rent. You can buy the washer dryer for $250. It's a pretty good return on investment there. So those are other opportunities to look for. So I would say ways to decrease costs by active management, small ways to increase revenue, constantly pushing rents, and looking for opportunities when you can to refi out any built up equity you can and reinvesting that into more deals.
Question for you along these lines, because I think one of the biggest differences that we see between the larger investor and the smaller investor is a lack of attachment to the asset from the larger investor, or a view of the asset as a functional utility, not as like my blood, sweat, and tears are in this thing, and this is my building. Any comments on that? Do you see the same thing? Do you think that the lack of attachment allows for, let's call it, more mobility to opportunity?
Absolutely. So the best clients, the biggest clients, everything is for sale for the right price, right? And if they see something that's the right price that they want to buy, they'll find a way to buy it. And everything's a number in a spreadsheet. That's about making money to their bottom line. They're about driving profit and making money. And that goes to too, like when you're emotional about a property, you've got to realize that maybe you'll let a person miss a month's rent and let it slide because they've been there for 15 years. You can't do that, right? Maybe you won't push their rent up for a year or two, and because they've been good to you and they've been there forever. And And so emotion does drive some of the smaller decision making. But I think once, our smaller clients start to realize that, no, like, this is how I make money. This is how I've seen some people that, Justin, it used to be additional income, their properties, and then they retire and then they realize this is my income, and their mentality switches where it was like, hey, I do this on the side. I've invested, I've bought these. And now all of a sudden, like, this is the only money I'm making to live off of now that I'm retired. And now it's like, well, I want to make as much as possible because that all is how much fun I get to have in retirement. So I think that's sometimes when we see a mentality switch. But yes, every deal is about making money, and you got to do the most you can, because remember, when you go to sell it too, all these things will pay off to you then as well.
It's interesting that you brought that up, because we recently had a client that we met with, and we were talking about their situation in their building, and they own now a very tightly rent controlled market. And their asset falls under rent control. And they had been that exact person, owned the building for 20 plus years, had a tenant in the building that that had lived there a long time. They hadn't increased rents from 2013 on. And then COVID happens. And as you just said, we're not going to see significant change in the ability to increase rents now until 2022. And, they were interested to see what their options were and what they could do, and to consider what might there be a better opportunity. And ultimately, the big sticking point was the fact that the unit where the rent was so low because they didn't raise it for all the years they could, then got stuck where they can't raise it for 3 more. That capitalized number significantly affected the price that they'd be able to sell the building for. And although it made sense and they understood the logic of why they couldn't get one price and had to be content with another, it still upset them so much of, quote unquote, leaving money on the table, that now they're not going to move forward. And they're not going to be, they would make more money. It'd be closer. It'd be more legislative friendly. But that perception of loss because of the inactivity of management is now going to keep them in a bad property longer. And so I think that we run into that a lot, and you see that a lot sometimes with smaller investors that aren't as proactively managing. And it didn't matter before 1482 or some of the rent control that we had, but now that it is more commonplace throughout Southern California, not taking advantage of that annual increase that you can get, whether it's 3% or 8.6 or whatever it is a new normal that people are going to have to adjust to.
Well, and Justin, to that point, to explain to everybody the difference between how a big operator thinks versus, a mom and pop operator. We had a client that bought, and Justin, this client very well. We bought 82 units in Costa Mesa. And during the contract period, there was a chance to roll a bunch of rents and increase them. And him and I got into a full-blown argument on the phone in front of the brokers on the deal about whether or not he had to use the local CPI for the LA Orange County area, or he could use the Western Regional CPI, which was a 0.5 point difference, so 50 basis points higher. But he went through the analysis with me and explained how, because if he pushed those people over the course of the next year and what he would get in the underwriting on the loan, it meant $60,000 more in loan proceeds to him, and just about a quarter of the units turning in that time. My point ultimately was he should just wait until April. The deal closed in March, wait for the April CPI to come out, and then raise everybody off that one, which was going to be substantially higher. He didn't trust me on that. And then it ended up actually costing him what would have been about $275,000 in proceeds and earn out by not waiting those couple extra months. But literally, we were sitting arguing over pushing it 50 basis points on the rent increase over $60,000 in loan proceeds on the acquisition, because that's how they think. Like, that's how the institutional people think. And he was like trying to have me find a way to force him into the 1.2 instead of the 0.7 CPI from April of 2020. So.
I love that story every time you tell it, because it's active management, and it's what people are doing right now to be successful. Let's switch a little bit. I want to talk to you a little bit about the cannabis segment of the marketplace. It's certainly impactful for all of our commercial owners. You got a fair amount of exposure in the cannabis space. What's the play today as it relates to it? If you own a building in a green zone or can be utilized for cannabis.
Yeah, look, I think if you have an opportunity in one of those markets, either that exists now or are going to be in an emerging market, there's a few cities that are putting dispensaries and other things on the table. Your building is worth substantially more. And you can either go through and try to start applying for the permits yourself or have us help you apply for the permits, because then when you go to sell the building with, the local permits, right? The state permits is a different process and that transfer takes longer, but the local permits for your building, if you can get your building into the system and we can sell those, there's a real premium on those buildings and those permits, especially in great locations. You're getting a premium as a tenant. And the other thing you can from your tenant, but the other thing you can keep in mind too is we have situations where we represent a lot of the big cannabis REITs, and they'll let you put the tenant in and come in and pay you to just buy you out right after and throw it into their REIT, right? And so there, if you just want to bump the value, but then you don't want to have a cannabis tenant, which plenty of our clients do, trust me, like plenty of my clients are like, I don't want a cannabis tenant, but I don't want to leave this money on the table and let someone else go do the work. So we help them prep, we help them do the work, we help them find a good quality tenant. In that time, we're also negotiating for them with the REIT to buy it, and the REIT gets involved in a little bit in the lease negotiations, and the client gets a better, higher exit than they would have if they just sold it and let somebody else do the work, and then yet they still don't have to deal with the tenant.
Talk to me a little bit about, we've seen that obviously there's a premium for, buildings that you can have cannabis in. What directions are lease and price premiums headed? Are they still widening from, let's call it a more traditional tenant or space, or are we seeing them, kind of come back? What's your take on that segment of the market?
I think there's still a premium, but I don't think it's as growing as fast as you necessarily would think it is. The premium has to do with safety and risk and the fact that, it's still not federally legal, but you have some of the biggest banks in the country right now that will bank cannabis companies and cannabis funds. So there's less of the issue of, oh man, my tenant's going to pay me in cash and I've got nowhere to put it. Like we have cannabis clients that bank at Torrey Pines, which I think is the 6th or 7th biggest bank in the country. And they bank cannabis funds, right? It's for sophisticated clients, for real estate owners that need to take tenant money. But it's as it gets closer to legalization, you're going to see less and less of a premium. So if you have something in that space, now's either the time to, get a tenant in, sell it, set it up. That now's the time to really be actively thinking about transacting on an opportunity if you've got a building that's well positioned, because there's still a premium, but over time it's going to disappear.
This is why I don't like to tell you some of the questions, because you get ahead before I can ask one. But I will ask it anyway. What happens the day the FDIC or the day FDIC insured banks can lend on cannabis property? What happens to the value with basically the lease rate somebody can get and the value of a building? If you're willing
the value of the building, well, so two different things. If you already have a tenant in there, the value of the building is going to go through the roof from a refinance purpose, because you're going to be able to pull out the max, right, from an FDIC lender. And I think that's an awesome opportunity. There are lenders out there right now that will lend on these buildings, and the rates aren't as ridiculous as they used to be, right? Like they used to be 10+%. They used to be really high. And, now you're seeing cannabis lending money in the 6s and 7s. It's still high. But when you start getting banks that can play in this space, you're going to start seeing rates go down, which will be great for you as an owner if you want to deal with, it'll be great as you want to deal with these tenants. You'll be able to cash out, refi a bunch of it. The other thing to keep in mind too is if you're not touching the leaf, right? Like if you're also not the tenant, we have situations where you can actually, go out and set up a holding company and have it hold that asset. And that holding company will allow you to, bank still at certain banks. And so certain banks might lend you the money even today, but it's just at a higher rate. But when it becomes federally legal, the rates will just plummet and you'll be competitive with a CVS. Well, they're not as good a tenant as CVS. So like a mom and pop grocery store.
You might argue that they're better.
Depending on cash flows, yeah.
But so when FDIC insured banks can lend on it, isn't the concern, or at least I think the observation would be that lease rates are going to go down significantly because you don't have to pay the premium to get in because you're a tenant that could quote unquote get in anywhere?
Yeah, the perceived risk goes way down. The only risk that'll remain at that point is a security issue and a perception issue from having it in your building. But everything else, the lease rates, like I said, they should get closer and closer and closer to market. I do think cannabis tenants will always pay a small premium for security and other purposes, right? Having a big cash business. But then as soon as it becomes federally legal, the security issues go down as well from them having to hold a lot of cash at the property, because then people can pay with credit card. That changes how all that operates. So it becomes less of a security issue then, but there's still some with just having the product at the property.
Yeah, I was asking because I think that there's been a great premium that's been built into the people that have been willing to lease to lease to tenants in the cannabis space, and that because of the increased lease rate, price of buildings or buildings that are in a zone that a user can use, might be the time to monetize them now, because the premium is so substantial and the premium gets minimized the second that it's wide open for a cannabis tenant to basically, occupy any building within a quote unquote green zone or whatever it is.
Yeah, I would agree. I think that there's a lot of opportunity now to take advantage of it. And I would take the time and reach out to an advisor, especially if your building's in an area where you hear that cannabis might be coming for the first time, or if you know that your building's in a green zone, and have them see if they can find you maybe an opportunity where you'll get the premium now and then, transition into something using that additional built up equity. Great rates now to trade up.
Thank you. I always appreciate a nice Centennial plug. Let's talk about your corporate work or your high net worth work. Is the California exodus real, decreasing, reversing? Where are you seeing, businesses and high net worth individuals? Are they staying? Are they leaving less? Are they coming back?
Yes to all of it. I think there's somewhat of a mix, right? You're getting places like LA where big tech companies are doubling down, right? Google, Apple, Amazon, all taking huge amounts of corporate square footage across LA. You've got a bunch of big corporations expanding down in Orange County, but then at the same time, you've got companies continuing to leave. I think the exodus is not as big as it was 18 months ago or 2 years ago, but there's still some people leaving, more of individuals leaving when they have the opportunity for the rest of life, as far as they see it, to work remotely. I think people are taking advantage of that opportunity. The high net worth individual thing is always interesting. Some of them are moving, some of them are finding ways to structure their estates where, they're not realizing income in the state of California. They're spending less than 180 days in California. They're doing all those things. I would say for those of you that are considering it, it's very tricky. You have to track it very closely. But I think that there's, especially Orange County seeing a lot of growth right now. I think there's some concerns regarding safety in LA, but Orange County is growing and expanding. And I think you're getting a lot of people moving from LA to OC, which is also helping Orange County. It's not just people moving in from out of state.
Thank you, sir. At the start of the pandemic, we predicted Boise, Provo, Colorado Springs would be hot exchange California markets. And I think we were certainly right, but it's almost 2 years from when we had those predictions. Where are you seeing clients go now? Any changes to that?
No, I mean, those are still really great. Still people trying to find stuff in Arizona. In the Phoenix metro area, I saw a chart the other day, but cap rates were only like 45 basis points above what stuff was trading for in LA and Orange County, which I think, Justin, when you started, if you would have known that now, you would have said that's pretty crazy. And some of the big brokerages are actually going to sell more out of Arizona this year than they will sell out of Orange County, which is from a dollar volume wise. So people are starting to look on the outskirts of, the Phoenix metro area has become really popular. A lot of people starting to look at San Antonio. San Antonio has become really popular recently as of late. And then other areas that you can find in Florida where population, is growing and expanding, like on the beach side of the Panhandle, that's been doing really well. The Tennessee market's been pretty busy, but Colorado Springs, I know you were even doing a deal there, I think, but it's blown up and taken off. And Indiana, we've Justin, we've been looking at a lot of deals together in Indiana. There's a lot of Indiana markets that seem to be growing, people leaving Illinois and going down to Indiana too.
Yeah, the Indiana one's been kind of interesting. I would say over the last 6 months, we've had a lot more interest and found a lot more strong demographic, I guess, support for investment there. What you can all see on the screen, and we've got a couple of them, is Jason was talking, or we were talking about going out of state, and Jason was talking about the Phoenix markets cap rates being so close. I think one of the things that we've been tracking and that we always try to look at is, kind of relative performance of property. And 2 years ago, we were big on Exchange, California, a lot of because of the legislation and some of the other tax benefits that might be out there. One of the things that we think everybody should be considering, I think that I would temper my points by pointing out that, yes, San Antonio, Indiana, Colorado Springs still, some of these places that Jason's talking about are maybe the next step if you are leaving California because of whatever reason, chase yield. But for some of these places, let's call it Phoenix, let's call it Las Vegas, let's call it Salt Lake City, some of these other markets. I'll quickly show you a Salt Lake City industrial graph with LA being in white. This is the average cap rate for LA industrial over the last 10 years and the average cap rate for Salt Lake industrial over the same time period. You can see that at the far right side of the graph, for any of these comparisons from Southern California to out of state, the cap rate is narrower today than at any point it's ever been, which might lead some people to move from investing in Salt Lake or Phoenix or Vegas onto some of these other locations, or to just redeploy their money into a Southern California market that may be a really core or core plus asset. The next one I want to show you as we look at this data, this is Panorama City Apartments and Burbank Apartments cap rates over the last, I want to say it's 21 years. I can't see the bottom of the graph, but if I remember correctly, we've got 21 years here. And you can see that probably on average, the cap rate in Panorama City has been between 1.25 and sometimes 2 points higher on average than the cap rates in Burbank. And today and over the last couple of years, Panorama City is trading at roughly the same cap rate. We call this gritty to pretty at Centennial, and it's something that we watched a guy by the name of George Karhalius do in Long Beach for the first time 15 or 16 years ago. And what his observation was, and he owned a lot of older buildings and tougher parts of Long Beach, is that he realized that, hey, you know what, I've got these properties and I could sell them at the time, it was probably a 6.5 cap rate. And I can go buy a building in a much better part of town at like a 6 or 6.25. And what I'm going to get over the next 10 years, I'm going to get better rent growth, better tenants, and ultimately make more money in a better location. And all I'm doing is trading cap rates, and I'm significantly improving. And I picked Panorama City and Burbank here because I kind of tried to pick two different areas that are on the furthest end of the spectrum in the valley when it was, let's call it, perceived quality of location as it relates to multifamily assets. And if you could take your Panorama City building and snap your fingers and have it in Burbank, I think we'd all do that all day, every day. So there's a lot of change that's happened over the last 18 to 24 months. There's going to be a lot of new opportunity as we move into 2022. Jason, just maybe your comments on people pulling back from some of their out-of-state investing, or people moving money from a grittier Southern California location into a prettier, as you just said, LA to Orange County location.
We're seeing a lot of it actually, and people that when they went to put the deal under contract to sell it, they were like, I'm leaving. And now they're like, well, I'm seeing a better opportunity to stay here and just trade up my building. We have a large client who, Justin, who's got a big exchange. It's close to $100 million exchange. And he's going out of a gritty San Francisco, Oakland group of properties into, some student housing near San Diego State, potentially. That's like a great product. And he's looking at an apartment building maybe on Sunset and Silver Lake that's new construction. And he knows he's going to drop down in some in his cap rates and what he had. But it's a better asset, a longer quality asset. And even on like the new construction one, he's getting himself out of rent control for the next 15 years. So that gives him in his mind more upside to continually push higher and higher on the rents there, because there's an opportunity. So, he's willing to go down because he thinks ultimately it'll allow him to go up. Down in cap rate, but up in product quality.
I think we're going to see, I think it's a really smart move to consider right now. 2 years ago, we were tracking 10-year treasuries and cap rates and how they were getting awfully close to each other, and how the delta between the treasury and cap rates is usually an indicator of good times to buy and maybe good times to sell, or at least peaks of the market. And we were getting pretty close. And usually a wise move, or what we've learned in the last 20 or so years of doing this, is that when you get to those points where cap rates start to get closer to the 10-year treasury and that gap narrows, flight to quality is the smart move and the safe investment. And I think that we'll see more of the higher net worth, larger owners continue to reposition over the next 12 to 18 months to get them in the most resilient, safest locations possible. And the great part about it is, whether it's 80 units or 80,000 square feet, all the way down to an 8 unit and 2,500 square feet, investors across the spectrum have the ability to do that in mutually beneficial ways for both the buyer and the seller to improve their situation. You wanted to make a comment?
Well, yeah, and two, we're seeing situations where, higher net worth people are starting to look at, and this will lead as maybe a little teaser into our next one on the 22nd, but opportunities for realizing gains, right? So if you've made a lot of money in the stock market in this last year, there might be an opportunity to, exit that and put into an opportunity zone, which we'll talk about, and that'll get you a real estate property with a lot of tax benefits. And those tax benefits will be hedges against tax increases in the future, change in laws. And the other thing is, and Justin, we talked about with one of our collective clients is, looking at your investing portfolios, maybe it's safer, instead of buying, treasury bonds or, municipal bonds, to buy a 4.5, 5 cap Starbucks, because Starbucks's credit is probably better than some of the other bonds that you might be buying as the base of your portfolio. And the difference is some of those bonds are tax-free, but you get the depreciation on the building, which offsets your cash flow and makes most of that cash flow potentially tax-free as well. So there are some opportunities even to position your, what you would have maybe considered as your equities portfolio. And if you think the market's going to be volatile over the next few years, position it into a really stable real estate asset with a great tenant. I think that's an interesting thing we can look at, and we'll obviously talk more about some of the capital gain side of it in a couple of weeks.
Yeah, that'll be fun to do, because I think we've seen a lot of clients really consider that. I mean, in the last couple of months, we worked with a couple, Frank and Kathy, who had a successful manufacturing business that they had for 40 years. And they were getting older, they were slowing down, had a big building where they were operating their business, and then the pandemic hit. And after being away and trying to restart, they kind of realized that sales weren't getting back to post-pandemic levels. It was really difficult to go out and find the talent they needed to operate. And this whole idea of starting over at 55, 60, 65, 70 just was a lot harder than maybe it was when they were in their 30s. And so what we've tried to do, and a lot of times work with Jason because of his opportunity zone expertise, is we took a look at the situation for this client that had a big, massive building. They had a business that had value. They weren't using much of their real estate. And what could they do to possibly do better? Because after coming back, it just wasn't that much fun. And so we put together a whole strategy for them as it related to their industrial property, where they could get the benefits of the opportunity zone to shelter some of their capital gain from the sale of the business. They ultimately downsized the business, sold the real estate, reinvested via a 1031 exchange to make significantly more cash flow than the business was paying them at the original property. Then in the smaller space, they kind of cut the waste that was attached to the business by paying rent on a big space, as well as having to have a building kind of that came along with it. And they were able to maximize the sale of the business and then redeploy that money into an opportunity zone that deferred their gain on the sale of the business till 2026, and then they could take all of the gain from this point forward that was in the opportunity zone tax-free if they held it for 10 years. So the ultimate thing that they've been able to get out of it is significantly more money. They got away from all the headaches and challenges that they were willing to endure, but really didn't want to. They make more money, they got newer buildings, and they spend a lot more time with their grandkids. And I think that, as Jason said, we'll talk a little bit more about how to use some of the opportunity zone things that he's uncovered over the last 4 years and working in them to benefit some of our passive real estate clients. But Jason, I think that as we move into 2022, we're going to see a lot more people realizing the opportunity in the game. Before we go, I think I've got a couple questions for you to ponder, maybe over the holidays for those of you that are joining us today. I think they're big questions that really would help dictate a successful strategy, not just for 2022, but for 2022 through 2030, and where you take your portfolio is, are you an active manager of multifamily? We'll define an active manager as someone who has multiple rental agreements for the unit, the garage, the space on the roof for the satellite, the access to the laundry room. It means that you're actively looking to upgrade not only the income stream, but the quality of tenants, and you're comfortable with intentional vacancy. And you might be somebody that now prefers studio and 1 bedrooms over 2 bedrooms because of rent control and because of turnover that you're seeking. So are you an active manager of multifamily? If you answer that question that you're not an active manager of multifamily, things have probably changed, or at least the marketplace has changed. And there might be better opportunities for you that more match up your management style and get you the returns and the gains you want. And we can talk about those in 2022. The other questions to ponder would be, why do Main Street investors evaluate property performance by rental income, and Wall Street looks at current and future return on equity? Jason and I didn't talk about it when we see the differences between our larger clients and our smaller clients. I think he might have mentioned it for a second, but how they evaluate the performance of the building, those two investor pools, is significantly different. And it factors into the decision making and really how much profitability people make. Owning real estate's been fantastic, and all of us in the business think that it's still the best investment that someone can make. But can you create multi-generational wealth in one 70-year span, or can you create enough to live on, or maybe to give to your kids? I think that's what we see as the difference. Jason, any comment on, how people evaluate the performance impact on ultimately what they're able to pass along to their family?
I think so. I think that there's a lot of thought that goes into that now. And I also think that, like you just pointed out, even our big clients think about deals totally differently, right? Like I have one client that only cares about GRM, and I have one client that prefers more about cap rates and NOI. And, it all kind of varies and differentiates, and it's how they look at the deal and how they leverage financing. But I think, all of them are looking at how do you, secure that wealth for long term? How do you pass it down? How do you do it safely? And, what is the way to grow that wealth? That's why a lot of people, are always trying to pull out as much as they can on loan so that they can reinvest it, create new depreciation. There's all those things that they're looking at. So.
Yeah. And I think that's a significantly untapped strategy for most investors that are, let's call it 10, 15, 20 plus year holders over the last 18 months, as we've seen interest rates drop to the absolute bottom, and we're seeing, rates in the high 2s to mid 3s across most products. Our largest investors will refi as frequently and often as possible to pull out equity to go out and purchase more properties and get additional depreciation. We don't typically see that from the smaller investor. And if they maybe applied a little bit of that thinking, they would ultimately create significantly more generational wealth 20 or 30 years ahead, but 5 or 10 years ahead, they'd have significantly more cash flow as well, by controlling significantly more square footage. Jason, we've got 2 minutes left. You got any closing comments you want to make as we finish off, our second to last webinar of 2021?
No, thanks for having me. I think it's been a great year for investors. I think it's been a lot of opportunity. There's been a lot of opportunity. I do expect the first half of next year to also be great and probably continue to grow, expand. Deal volume is going to be high. I think that there's a lot of opportunity to look at taking advantage of over the next 6 months, and then probably a little bit of uncertainty towards the end of the year based on elections and other things. But if you're considering adjusting your portfolio, repositioning your assets, doing certain things, now is really the time. Like interest interest rates being low help everybody. They help you as a seller because your buyers can afford to pay more because they can cover a lower rate. It helps you when you go to buy because rates are more, so you can get more for your money. There's a lot of opportunity. People are still feeling good about 1031. There's just a lot of things going on, but anything can change at any time. So I'd say really take some time, sit down. I actually appreciate for my clients is the advisors are willing to analyze stuff with you for free, and if it doesn't end up in a deal because you're in a great situation as you are now, understood. But most oftentimes there's a way to reposition yourself to meet your needs in an improved manner and make you more money. So it's just, worth a shot, sit down, take a couple hours and work through it.
Thanks, Jason. I'm going to finish with a quick comment on this graph because it dovetailed something that you were talking about, which is taking advantage of opportunity in the first 6 months of the year before a lot of things may change. Back in, I think, April or March of 2020, when everything started to change, maybe it was May, you and I shared this graph when the orange line was at its lowest point. And we talked about then, because interest rates had dropped so much and cap rates had pushed out, that it was creating a window in 2020 where the difference between cap rates and the 10-year treasury was widest it had been in 21 years. And 2020 and 2021 have proven to be some really good times to grow a portfolio of real estate. What you can see here on the far right portion of the graph is that those numbers are starting to creep together again. And to Jason's point, we've got a window. Things are going to be good for a while, but not necessarily making moves, but understanding what your opportunities and potential are things that we would love to help people do in 2022. We take a lot of pride in helping families make things easier, make more money, get into better situations, not just for the main property owner today, but also for future generations. So if there's anything that Jason or our team can do to help you get a better handle on your real estate and create a plan that not only helps you meet your goals today, but puts you in the best position possible to meet your goals in 10 or 20 years, we'd love to do it. We hope everybody has a great holiday. Like I mentioned, and Jason mentioned a couple times, we'll do this one more time this year. On the 22nd, we're going to talk about the Opportunity Zone secret. I know we're both really excited to kind of review and share some of that information. We've spent a lot of hours talking to a lot of different people to make sure that these things that we see as opportunities are as lucrative and also safe as we think they are. And so we'll be excited to share with you our findings then. Hope everybody has a great evening. Thank you for enjoying our webinar, and we'll talk to you soon.